Hello, my name is Savannah, and this is my Finance 695 project, Better Than the Rest Investment Breakdown. These are the companies that did not make the cut. I used a lot of different variables to decide which ones they would be, and I'll go through how I decided that in a moment. But Autodesk, URS, Metasys, Valero, CAT, just some of the few that just didn't quite have the numbers that I wanted to make it worthwhile to invest in. So one of the first things I looked at was liquidity ratios. I wanted to see if each company would have trouble paying off their current obligations. As an investor, I want it to be high enough to know that they can handle their debt, but not so high it signifies they aren't putting the extra money in a better investment option, or they have a large inventory that could become obsolete and it'd be a waste of money. I compared current, quick, and cash ratios. I also used some of the leverage ratio, so equity multiplier. It explains that companies that have a lot of leverage or liabilities have a high EM because the assets are financed with a relatively smaller amount of equity. So the ROE kind of depends on the ROA and that use of leverage. And the equity multiplier formula is total assets over total equity. Then moved on to profitability ratios. I used profit margin, which is net income divided by sales. And this measures how much out of every dollar of sales a company actually keeps in earnings. I also used ROE, which I do find very important, as discussed in presentation 1, and it did actually show a significant trend depending on the industry and depending on the year. Not really something you can use all the time or alone, but ROE is definitely an important factor that I wanted to use. And that's net income over total equity. And a high ROE means investors are getting a higher return. And if I'm investing in a company, that's exactly what I want to see. ROE is useful for comparing the profitability of a company to that of other firms in the same industry. ROE is how much we're making the shareholders, and it can be driven more by leverage. I also used economic value added, which is the net operating profit after tax, or what we make, minus capital charge, or what we want to make. And it looks at whether it was paid above and beyond what it's worth or should be getting. So you don't want a negative EVA, but you don't want something so high that, let's say it was a project that was set and it's doing great, but if it's a constant fluctuation of these values from negative to positive, and you invest at a time when that EVA is extremely high and overvalued, well, if their next project isn't so good, you've probably lost some money on that stock. And that's something I want to avoid. I want to look for more consistent EVAs, something that's slowly rising versus just jumping up and down. So with those, I came to my top 6 of Coca-Cola, John Deere, Intuit, Fluor, Monster, CB&I. So I continue to use the same formulas to further migrate down to my top 1. So looking at Fluor, the reason I cut it out, they were able to pay off current obligations, but it wasn't as liquid as I would like. Their leverage was a healthy ratio, and their profit margin was a little low for comfort. This is probably kind of one of the top, the number 6 of my top 6, and just barely at that. They have a very low profit margin, although it was positive and it was growing, which is a good sign. And they also have a decent ROE and a healthy EVA. There's just a little too much uncertainty with this company to feel comfortable investing in them. CB&I was my second cut. They weren't bad overall, but they had a low ability to pay off current obligations, and their cash ratio is alarmingly low. So for my personal preferences, I like to see a company that can pay off their debts without it being a great amount of cash left over or assets left over. I want them to be able to at least meet their current obligations. And I want them to be liquid to a degree where if something were to happen, I'm not going to be affected as bad as if they can't pay off their obligation or if they can't turn their assets into something liquid immediately. So that's why I kind of really look for those values when I'm going through these companies. Their PM could have been a little higher, but their ROE was on a steady climb, and their EVA was a little low, and so all these factors made me eliminate CB&I. John Deere, the next one cut. They lacked the ability to pay off current obligations, and again, this is important, so it wasn't a very hard decision to take them off for that. And they did not show that they were liquid. Matter of fact, all of their liquidity ratios were well below 1. Not something I'd be comfortable investing in. Their leverage ratio was a bit high for comfort, and with such a low current ratio and this high leverage, I would wonder if they could pay off their debt at all. If something were to happen, I'm going to suffer, my ROE is going to suffer, and I don't want to take a chance with that. ROE did have a good return, but again, I think that's at a very risky cost of what I'm going to put into it. Don't want to take that chance. Looking at the EVA, they were negative for a while, but in 2013 they shot a bit high. They went from negative 122 up to 2,458. So while that might not be a bad thing, I don't know why they jumped so much, and I don't want to invest at this time and then next year it drops back in the negatives, and then now what I've paid might have been overvalued and now it's not worth as much. Coca-Cola was the next. They had the ability to pay off current obligations, but they aren't as liquid as I would like. Using a healthy amount of leverage, which is good. They did have a very high profit margin and a good ROE. And the EVA is starting to get on the high side, but still good. I would mostly be concerned with how much higher it would get, because from 2011 to 2012 there was a significant jump in the EVA, and that kind of concerns me a little bit. So now I'm getting down to the nitty-gritty, my top two. My first one is Monster Energy. So a little bit more about the companies and why it kind of became a little bit harder between the two I'm about to explain. Monster Energy is an energy drink launched by Monster Beverage Corporation in April 2002. They advertise mainly through sponsorship of sporting events, including motocross, BMX, mountain biking, snowboarding, skateboarding, car racing, speedway, and esports. Honestly, I think that's an amazing way to market. You're not having to create a specific commercial for the TV. Instead, you have your logos, your sponsorships at the races, the games, and then those are in fact televised on TV. So it's in fact actually on TV commercial. So you have that dual sense of advertisements. I think it's a great use of marketing. Monster has a great ability to be liquid and has the ability to pay off their current obligations, which is a good thing. I would start to get concerned if the current ratio rose any further though. With such a high current and cash ratio, it shows me that they have their money tied up in a non-productive asset or they just have a lot of extra cash left over, when it should instead be invested in a more profitable avenue. I don't want to invest in a company that does have a lot of cash hanging around, because I don't have as much control over that company if they're using more leverage. But they did maintain a healthy level of leverage. So Intuit was my second top two. So Intuit Inc. is a software company that develops financial and tax preparation software and related services for small businesses, accountants, and individuals. You would know this as Quicken Loans, QuickBooks, and TurboTax. They are able to pay off their liabilities, and they're relatively liquid, which is a good sign to me. They also do have a healthy use of leverage as well as a good profit margin. And they have a high ROE. It's not as high as Monster, but it is a different industry, so we really can't compare back and forth. But for their industry, I am quite pleased with their ROE. My top pick, though, was Intuit. Here's why. So it was really a tough decision between Monster and Intuit, but the main difference was Monster almost had too much cash and not enough use of leverage. That was a concern to me. As an investor, I want to see less cash and more leverage, because then I have that better control over that firm. I have the potential to get more ROE out of this because I'm able to control what I'm putting into it. As an example, Intuit used 41% of debt and 59% of equity to fund their operations, but Monster used just 29% of debt and 71% of equity to fund their operations. Here's a chart of the stock history for the past 5 years for Intuit. I like this aspect too because over the years they have consistently grown. There hasn't been a lot of dramatic spikes and drops. It's just consistently grown, and I like to look at things like this. So I went ahead and did a market to book analysis on Intuit, and the market to book ratio was 7.88. The market to book value are thoughts of stock price in the future relative to what shareholders have in the business. So here, for every dollar put in by shareholders, equity is worth 7.88 times more. I like this number, and this is what I'd be looking for if I'm going to invest in somebody. And also with that high ratio, it prevents the risk of someone coming in and buying that company out. And firsthand, I know this type of experience. The company that I work for now has been bought out twice. And through these buyouts, a lot of money is lost just kind of going through the transition, or the types of companies just don't match up. So there isn't a level playing field. So if you have a company that can be bought out very easily, it's kind of makes it shaky for the market of whether you want to invest in it. So Intuit not being so easy to be bought out makes me feel a lot more comfortable with investing my money into it. So here's a last minute history lesson. Intuit was founded in 1983 and they went public 10 years later in 1993. The corporate headquarters is located in Mountain View, California, and they have over 8,500 employees. And almost every year since going public, they've acquired another company without affecting any of the ratios that I've compared. And this shows me that they did the acquisitions methodically and never overextended themselves. I know a lot of companies that do buy out others, they will overextend themselves and their stocks and their ratios will suffer greatly. But I do feel comfortable with putting my money into them because each time that they do make these acquisitions, they're doing it right without affecting everything. So I like that. So my conclusion, while Intuit is my top choice, and I absolutely go with that full, I would actually still consider investing into Monster as my secondary. I still like them. I still like their ratios. I would just want to put more into it. I would also want to pull in other companies into my portfolio, but that would require another analysis of a different set of companies. I don't think I'd put anything into the rest of them besides Intuit and Monster. So I'd have to do maybe a totally different industry and figure out what I'd want to invest in, but do this exact same calculation and analysis to figure that out. Intuit covers a wide range of financial services and tax software. And TurboTax actually happens to be my favorite software to get my taxes done. And you know, we all love taxes. Thank you.